I'll be talking about interest rate swap in this recording. Recall where we're coming from. We've been learning how to manage financial risk. We've looked at FX risk. We've looked at interest rate risk. For FX risk, we said you can use forward, you can use money market hedge, you can use options, you can use futures, you can also use swaps, and swaps can be forex swap or currency swap. Now we move to interest rate risk management, and under that we've looked at forward rate agreement, we've looked at the options on forward rate agreement, which is also called interest rate guarantee, IRG. Then we move to futures. We also talked about the options on those futures, interest rate futures, and options on interest rate futures I've also covered in my previous recording. Now we are looking at swaps, interest rate swaps. And the way I'm going to deal with it is I will give you a quick background of what it means, which is quick. Then I will use these questions to actually drive down your understanding such that whenever you see a swap question, it comes handy and easy for you. Swap is arguably the easiest, right? So you shouldn't struggle with it. What is interest rate swap? Please, it's pretty easy. What we are saying is an agreement where two parties agree to actually swap fixed stream of interest payment for floating. Or you say they agreed to swap a floating for fixed. Either way, they are swapping. Please note that what they are swapping is interest rate payment. And there are two types of interest rate payment. You can collect loan at a fixed interest or at a floating interest. Floating interest means it varies. It's a variable rate. It changes with the market. And don't always think, why would two people have different views? In a market, the same way you are risk averse and you are looking at, you don't want fluctuation, you want something fixed. There is somebody that is risk loving, that wants to take advantage of market and will be happy to take a variable interest loan. So because of that, these opportunities will always be available in the market, and it's always there for any of the counterparty to set up what they want. So what is interest rate swap? Like I said, interest rate swap is just an agreement between two parties to swap fixed stream of interest payments or cash flows for a variable or floating stream of interest payment. And before I go on beyond just this definition, it's quite important for you to also understand that there are some key attributes that are quite peculiar to this swap, and which makes it quite different from the forward features that you've been learning about. And the first thing I'm going to mention is the fact that for this one, the focus is on interest payment. Please take note. So what this means is that principal is not swapped. When we did forex or currency swap, you realize that we're swapping principal amount. Here, we're not swapping principal amount. The only thing that we swap is those interest payments, floating interest payment and fixed interest payment. So please take note of that. Number two is the fact that this particular arrangement can be used for a longer period of time. Unlike futures and forwards that can be used for short time period, 3 months, 6 months, 9 months, and all. This one can even go as long as 10, 20, 30 years. And the most interesting part of it actually is the fact that swap can be used to actually secure a cheaper interest loan. I think you probably realize that that's also possible when you use a currency swap. For different currencies, you might be able to get something cheaper. And that's why swap is quite very interesting. So those are the key attributes that you really need to take note of when you are talking of swap, and it's quite unique. So let's look at that question. Company A. Like I always advise you, take 1 minute to look at the question so you can follow what I'm doing. What is going on with company A? What is the objective? The objective of company A is that it wants to pay floating. Remember, there are two companies here. There's company A, there's company B. So let's say let's put company A here and put company B here. So what does company A want? company A wants to pay floating. So that's what they want, pay floating. Whereas B wants to pay fixed. The good thing about this is that they have not collected any loan. So we have the liberty to advise on what they should be taking. And this is the part where you have to pay attention, because I'm going to be giving you the clue and the steps you need to take before you set up the swap. Yeah, please pay attention to this. Remember, these are the objectives. Very important. That's your starting point. You need to know what they want. This is what the companies want. Yeah. Now, what are the steps I've been talking about? When you have this situation like this, where nobody has taken any loan yet, then you need to advise them on what they have to do. What do they have to do? Step one is for us to determine what type of interest will give the highest savings. Is it floating or is it fixed? So we need to determine what type of interest will give the highest savings. And how do we do that? So we know that fixed, we've got fixed and we've got floating, right? So we need to know, is it floating or is it fixed? Yeah, floating. Right. So what we know for sure is that company A can get fixed at 10% and can get floating at base plus 1%. Whereas company B can get fixed at 13% and it will get floating at base plus 2%. So which means in this situation, what is our total savings for each type of interest? This is equals to 3%, as you can see, 30 minus 10, and this is just 1%. Quite obvious there. Right, so now we know that the answer here is fixed. So it's a fixed that has the cheapest savings that we can get the highest amount of savings. So this, if I call this step one, yeah, step two is to identify the party who can borrow at the rate you have identified in step one. Since we know that it's fixed, yeah, and that is 10%, that is the rate we are talking about. Who is this party? It's party A, who is able to borrow at that rate. So we identify that as party A, we note it down. Then the last step is to instruct that party to take that loan at that rate. So, which means the party that we have identified in step two must borrow at the rate that gives the highest savings. And what this means is that party A must borrow at 10% and party B must borrow at base plus 2%. As you imagine, if you have said that party A must borrow at fixed, because that is what we are talking about, party A must borrow at the cheapest rate, then party B has to borrow at floating, because there has to be opposite direction for them to be able to do swap. And party B cannot borrow at the floating rate of party A. He has to borrow at its own floating rates, and that's base plus 2. And that is a problem a bit for us, because we will not be able to maximize these savings, because both savings of 3% and 1%, we're able to achieve them because of party A. So if party A has taken 10% fixed, it cannot take base plus 1 at floating again, obviously. And party B cannot take fixed, obviously, but has to take a floating at its own base plus 2. We're going to lose these savings. And that means is that we only have 2% to share amongst the parties. So the net savings is actually 2% on this swap that needs to be shared. Let me just put it here so you can see it, and we'll get there. Yeah. Because unfortunately, we're going to lose this 1%, so we are left with 2%. So we'll keep this somewhere here. You'll see how this will happen. Invariably, what we're saying is when swap is done, the savings usually are being shared amongst the counterparty. So eventually, party A should get 1% benefit and party B should get another 1% benefit. Yeah, as they share that total savings. Now let's go into the swap arrangement quickly. Now that we have set up what they need to borrow, and then they need to swap after. So I'm going to start with the initial transaction. So I have initial transaction. which we already know. Make this bigger a bit so that you can see it better. Yeah. So I'm going to have party, let's call it A. Just say party A. And this is party B. Right. So initial transaction is that it has to pay at 10, A will pay at 10%. We've seen it, and B at base plus 2. So this will be 10%. Let me make it negative so that we can show that it's paying. Yeah, and this one also will pay at base plus 2. 2%. That's the initial transaction. Now, there's time to do the swap, because what party A wants is actually to pay floating. And that's what it wants to now. So A pays floating to B. So which means floating is base. Please, once you are talking about floating, don't get confused as to floating plus what. It's always the base rate you must use for the swap. It's only the transaction that will have the spread. Please don't put spread in your swap. Spread is specific to companies. Remember, spread is tied to the credit risk of the company, so you don't swap the spread. The spread stays with the transaction. So if you are paying floating, then negative base, that is strictly what the floating is all about, just the base. And this guy will collect that base rate. Yeah. That is what A wants anyway. He wants to be paying floating. But B wants to pay fixed. So B then have to pay fixed to A. So that means that fixed that we're in the transaction is 10%. So that means A gets 10% and B will have to pay the 10%. And when you look at this, you can actually get your swap effective rate on that transaction. So with the transaction, with the swap, what is the net? Yeah, and you discover that the net should give us something quite beneficial. If you do this, this will net off and you're only left with base. So party A is only paying base. And party B, if you do all of this, we'll have 12%. I remember that this is negative base, negative 2 in bracket, right? So base will cancel base, and you have negative 2, negative 10, and that's how you have 12%. So negative 12%. So they are both paying at 12%. B is paying at 12%, A is paying at floating of base. Is this good? Let's find out. If they had not done the swap, what would have been their situation? So without swap, what would that have been? Without swap, A wants to pay floating, and the floating they will be getting is actually base plus 1. So it would have been paying at base plus 1%. And B wants fixed, it would have been collecting fixed at paying at 13%. You can see. And the savings actually showed up easily. The savings is clear because now without swap, instead of paying base plus 1, with swap is just paying base. So that means he has a 1% savings. This guy would have been paying at 13% without swap, but with swap, he's paying at 12%. That's also 1% savings. And this 1% and 1% is the 2% that we identify here, actually, at the early stage of the transaction. This is what they have shared. They've split that savings equally amongst themselves. And that is the benefit that we're talking about. Now, let's look at another question, another nice question here. And before I go into the question, this previous question that I've done is a scenario where you have between two companies. But in reality, most times, this swap is actually done between the company and the bank. So which means bank will always give you a quote. And what I want to spend a bit of time now to explain is the quote system. It's very important that you understand this quote system. Extremely important. Because if you misinterpret the quote, then you don't stand a chance. Yeah, and the rule I'm going to give you for the quote is to always interpret the interest rate quote from bank's perspective and fixed rates. Yeah, so please take notes. It's always from the bank's perspective and using the fixed rate. So what we are saying here is that if you are talking about fixed rates and you have a quote that is always going to have both sell and buy quotes. Remember, bank would like to sell high and buy cheaper. So we're talking about fixed rates. When do you receive fixed rate interest income? You will receive when you have sold something. So which means if bank is receiving fixed, it means that they are using the sell rate, and if they are paying fixed, it means they are using the buy rate. It's as simple as that. So think about bank, think about fixed rate, and everything is pretty straightforward, like I've always told you. So sell rate is when the bank is receiving the fixed rate, yeah, because when you sell something, you receive cash flow, right? And when you buy something, you're gonna pay. So bank will pay at the bid, which is your buy quote. Yeah, which is always the lower rates, and they will receive fixed at the ask or sell quote. Please take note, the difference between these two is usually the spread of about 2 basis points or 5 basis points, whatever the bank wants, that you will see them asking for, and that will show up even in their quote easily. So please, this quote system is very important for you. Take note so that you can always interpret correctly. Right. Now let's quickly look at this question here, the CoA company. Let's see what is happening with this company. Take 1 minute to look at that question. What you realize there is that what is the objective of this company? I like to always start from that. It gives you direction straight away. This company wants to pay variable. That's what it wants. Currently, it has a fixed rate loan, and his objective is to change it to floating. He wants to pay floating. This guy wants to pay floating rate, base rate. Yeah, that's what he wants. Yeah, and if he's going to pay floating, then that means for swap, he must receive fixed. That's the situation. So that's the objective of the company. So of CoA. What will be for the bank? It's going to be the opposite. Yeah, so which means bank would rather want to receive floating. They would have to receive floating, and they will have to pay fixed, because it must mirror the opposite of what company wants. The question is what rate? Bank is paying fixed. If you look at the code 4.9 to 4.95, the bank will always pay at a lower rate, and that is 4.9, and that is why this will be at 4.9%. Yeah, so that's the fixed rate that is applicable. Remember, the floating rate applicable will always be the base rate. I've told you before. Please take note of that. Don't forget. Don't get confused. Don't bring in spread into your swap. Only use your spread in your transaction. So we want to get the financial position of CoA. So let's set it up. What's happening currently to CoA? Currently, company A has fixed rates of 5% that is paying, and he has decided to go into swap where he's going to pay variable and receive fixed. Right. So pay variable means he's paying variable at base. Like I always tell you, when this variable is always at base, and fixed is going to be what the bank is ready to pay. So he's going to receive fixed at 4.9%. And if you check the net of that situation, trying to get our effective swap rate, our effective swap rate is base. Yes, base will still be there, and you are left with 0.1%. So that's base plus 0.1%. Base plus 0.1%. Right, and that is the situation. And you can see that without swap, this guy, what rate do you think we would have been paying? Without swap, we would have been paying at base plus 12 basis points. That's base plus 0.12%. So without swap, he would have been paying at 0.12. And with that, he has been able to make some savings. of 0.02%. So his savings is 0.02%, which is quite great for him. Yeah, because he did swap. We will not be paying at this, but we'll be paying at this. And that's for company A. Yeah, similar way you can have the other way around, which is this example that I have, similar to what we've just done. Yeah, and here, if you look at this question as well, all you need to ask yourself is, what is the objective? What are they trying to achieve? What is the company B trying to achieve this time around? We're talking of company B. Yeah, company B is what we're talking about. What is the objective? Company B actually wants to pay fixed. So if he wants to pay fixed, then the bank must be receiving fixed. At what rate will bank receive fixed? I told you bank will receive at higher rate, so that would be 4.95%. Yeah, so he wants to pay fixed at 4.95%, and he will receive floating. I always tell you floating is a base rate, right? You don't need to stress on that. Then bank will have to do the opposite, as you would expect. So bank will receive fixed at that rate and will pay floating, which is the base. Yeah, so with this, quickly you can determine the financial position of company B, Co B. Currently, we know what is going on with him. Yeah, so currently, we know that he's currently paying at base plus 0.15%, 15 basis point, right? So that's base plus 0.15%. That is current situation. Yeah, and it's going to be paying fixed and receive floating. So it's going to pay fixed, put that here, receive floating, put that here. So this will be negative 4.95%. And receive floating, which definitely you know is going to be base. Yeah. When you look at all of that, we can get this swap effective rate. Yeah, which is here. That is base. We'll cancel base here. And you have minus 0.15 and minus 0.495. So his net interest rate is 5.1%. So he's actually going to be paying his fixed rate at 5.1%. But with that swap, what does this mean for him? If he did not do swap, if he decide not to do swap, he said he can get a fixed rate at 5.12%. So he would have been borrowing at 5.12%. And as you can see, the same amount of savings is what we are finding here, because if you deduct that, this minus this, is able to save 0.02%. That is swap for you. Yeah, the last thing I'll just talk about is swap option. Swap options. This one, I'm not going to do any calculation on this one because it's not really that big in your syllabus like that, but it's just the same way you've been looking at options before on IRF, on IRG. And what is that talking about? It's just option on swap. So you don't have to do the swap until you are sure that it's beneficiary for you. So you just have some flexibility, you have some right. This is also what is called swaption, because swaptions, yeah, it's the same thing as swap options. So which means you have the right, you have that flexibility to decide whether you want to use your swap or not. And please note that you will still pay your premium when you are buying options. When you have a swap options, you buy it, you pay premium on it. Yeah, and then you exercise if you think it's good for you in money, or you abandon it otherwise. So that's it for interest rate risk management. We'll move on to other part of the syllabus in the next videos.